Hi, Dominique, and welcome to another edition of The Week Ahead. We've gone back for myself to our island background because I'm no longer on an island in Fisher Island in Miami. I'm back in London, hence the sweater, although today is actually fairly nice. How are you doing? How's life in LA?
Life in LA is great. The weather has been really awful, the worst in 50 years, but we're finally getting a ray of sunshine. So things are looking up.
Good. Okay, let's dive right into it. And as we always like to do, what are your views, or what are your big takeaways from Fed speeches, from data that came out, and of course from the market reactions to that?
Well, it looks like the much.
Oh, sorry. Before we start, sorry to interrupt you. I think our last week, where we were calling it Recession Fears 4.0, we're already right.
Exactly. That's what I was going to say. The much expected and feared recession and not happening. The so-called banking crisis turning out to be a nothing burger, to use an Americanism. Yeah. So we are kind of back where we were a few weeks ago. But seriously, if you look at the deposit data, the Fed lending data, the lending data from the commercial banks, it's all good. Stabilization. I mean, the decline in deposit we're seeing is just at large banks because they are involved in QT, and QT cuts the quantity of deposits in the economy. So, that's a bit of a pickle for the Fed. They had their minutes published and they were hoping for this beautiful Goldilocks banking crisis that is not too hot, where you have, economic Armageddon, and not too cold, so that inflation is tamed a little bit. They were really hoping for this. That's the main message of the minutes. But it seems a little outdated already. And in fact, what's interesting is that we had two speakers, one considered a dove, that's Williams, and one who is more hawkish, that's Waller, and they were saying the same thing. We are looking at the data and the signs of this crippling credit crunch are just not there.
Right. But what's daily in San Francisco? Because she came out with woman, right? And she came out more dovish or something, and isn't she more of a hawk?
Yes, she and Goolsbee, who is the other super dove. Goolsbee is the president of the Chicago Fed. Think that there may not be a need to hike further. I mean, Mary Daly was more, she hedged more. She was a proverbial two-handed economist. Sometimes I wish economists were not, doves or hawks, but more like octopuses, because they have 8 hands, and then they would be able to capture more than 2 dimensions of what is going on. But anyway, so President Daly was a bit more dovish. But what was interesting that these two permanent voters on the committee, so one being the New York Fed president, Williams, who has the best and most up-to-date data on what's going on in banks and the US financial system in general, came to the same conclusion that no sign of a crisis and no sign of progress on inflation either. Because
what's changed? What changed during the week? Because the narrative was CPI in general, and the details was about what was expected to maybe even a bit softer. And then obviously the narrative changed a bit later in the week. Do you agree that CPI, the headline and the details, was about in line to slightly softer?
It's in line, but it's not showing, as both Waller and Williams said. If you look at the data, really look at the data, it's not showing a slowdown. So yes, we had a bit of a slowdown in shelter cost, but I mean, just look at the data month on month and plot the CPI, the shelter CPI, with rent indices like Zillow or apartment list, and guess what? Those indices are going up, not down. So, you know, our expectations that shelter cost would come down was based on those indices going down. The only problem is for the past couple of months, those indices have turned up. So Williams and Waller are looking at the same data that we are looking, and they are getting worried because there's no progress. I mean, if you look at the month-on-month change, you'll see that the month-on-month decline we had was the same we had about 4 months ago, and then the index went up. And meanwhile, there is something really important that popped up last week, which was not in the Bloomberg calendar, but still something which we wrote about. Viresh wrote about it, which was the EIA. So this is the Energy Information Agency of the US government, revision of the balance between demand and supply, which led it to believe that there would be, you know, a much tighter market in the second half. And this is not just the US government, but the IAE, International Agency for Energy. This is becoming a consensus. And when you look at the relationship between energy CPI and core CPI, and you're seeing that energy CPI has been falling since the middle of last year, but core CPI actually has been accelerating, certainly not falling. If you look at the index, you should get worried, because it means that if we get a shock to the system, an energy shock, we're going to see core inflation move to a higher path. And I'm quite sure this is what Waller and Williams are looking at when they see the data. And that's why, you know, they were quick to stress that there is no sign of this miraculous credit crunch, but that the Fed could be in trouble in the latter part of the year.
And then the Michigan survey that was on Friday?
Yes.
So people were concerned about 1-year inflation expectations rising significantly more than people thought. And that's because, do you think that's because of gasoline prices have been rising over the last month?
Sure. And if you look at wages, the other thing that must have gotten people worried was a turn up in the Atlanta Fed medium wage, 30 basis points higher in March. So I think now it must be about 6.4 against, we had several months at 6.1%. So for sure, and we discussed, this is something, Andrew, we've discussed many times before. How do people form expectation of inflation when they buy things? And one of the things that is a big item in their budget is gas, and you know how important cars are in American life. So people fill their cars and they look at the prices going up and they adjust their expectations accordingly. Frankly, this is not looking good. The inflation picture is really not looking great. So I once more beg to differ from the market consensus. I don't think there is much progress on inflation, and I think the upside risks are piling up.
I know we talked about, you know, these, you know, somewhere like a forward starting, like 6 months, 6 months, or 6 months and 1 year, 1 year and 6 months time, type trade on front end in US treasuries, that could be kind of an interesting trade, just pricing out the
cuts,
all the big cuts. And some of the, obviously a decent amount of that has come out, but probably think that will continue. Because when I read some of the comments, they're even saying, you know, they're just using that base of, even if you don't think we're going much higher, there's no reason that we're going to cut. I mean, which has been a consistent message, and the market hasn't agreed and tried to fight it. And in these different kind of, you know, mini recession fears or, big credit crunch. And now I think it was just like a double whammy that bank earnings actually came out okay to good. Like JP Morgan, as an example, was up a lot. And then you had the things like Atlanta Fed and Michigan, especially the Michigan inflation expectations that kind of spooked the market. Interestingly, the equities kind of came back. Are you surprised about how fixed income and equity markets are trading, or?
So for once, I've been on the camps of equities because there are good macro reason not to believe that this would be a major banking crisis. So for once, it seemed to me that the equity prices made more sense than bond prices. So, I mean, yeah, some of those rate cuts have come off, but we're not really seeing the big curve flattening I am expecting when the bond market finally realizes that inflation is going to get worse, not better.
Right.
So I'm still waiting for that. Maybe that's, as you said, a good opportunity to put trades on.
I was just seeing that Bilal released on Friday his macroscope, his 3 puzzles to solve, which was like, I mean, I don't know where it comes up, but it's just so creative every week. And one of the mysteries to solve, or puzzles to solve, is over the last, say, month, by seeing movements that, more like how the markets got very worried about recession, why had equities hung in there? Now, obviously, some of those recession fears are going away, but it kind of breaks down why, especially for the US market, why it actually does make sense. So that's kind of a cool thing that people should check out. So, okay, cool. So for the week going ahead, what are the key things for people to look at? And
okay, so let's start with the Fed. They are going to publish the Beige book, though, to be perfectly honest, Andrew, I failed to get excited by the Beige book. Actually, the history of the Beige book is, the Fed has a number of books they prepare for their FOMC meeting. There is a teal book, a couple of other colors. And once, I don't know, 40 years ago, some congressman got very excited over the Fed not being transparent enough. So he insisted they publish the Beige book. And that's why that book and not the other ones get published, but it is so nuanced, right. Talking about an octopus economist. I mean, there are so many shades of gray in that document. It's really hard to get a clear picture of what is going on. Right. So we get that Beige book.
I know we're using machine learning, natural language processing to kind of go through that and try and understand that.
Exactly. Then we had a little bit of noises about the search for a replacement for Chair Brainerd. So we might get an announcement within the next few weeks. This will be a dovish economist. Also, several Democratic senators have made some noises about need for diversity. So probably a minority as well. Then in terms of speakers, next week we get Williams, Waller, Mester, Bostic. And I think Mester had toned down her hawkishness recently because of the risk of a credit crunch. But now that the risks are becoming less and less, she might be a bit more stative.
And Bostic?
Bostic is traditional a dove, so I think he'll traditionally a dove, so he'll probably continue with his dovish spiel. And then at the end of the week, we have the start of the pre-meeting blackout. And of course, we will get one more Fed balance sheet and one more commercial bank's balance sheet, but there is no prize for guessing what they will show. Continued decrease in Fed lending, continued increase in bank loans, stable small banks deposits, continued decrease in large bank deposits due to QE.
Right. And just to reiterate for our listeners, like on Twitter, when everyone's like, oh my God, this is horrible, lending's falling down, but, your view, which makes a lot of sense, is if the economy is fine, businesses and consumers, especially businesses, they may not need to lever up.
Exactly.
Exactly. It's actually when their businesses aren't doing well and they actually do need to take leverage to get, to get extra cash to be able to pay their employees and run their business. And that's really, or maybe take care of other distress opportunities that they see. But this is not the world's coming to an end. If anything, it could be perceived as the opposite.
100%.
Yeah, that's a great point.
So that's the Fed. And in terms of
one question on jobless claims, because I see the numbers a bit now. There's like 230 or something. Is that just because of the way? Is that 230 4 or 5 months ago, or since they changed the calculation, that 230 is still like around 200?
Yeah, so basically this is an indicator which is low quality because it's based on states administration of unemployment benefits. I mean, unemployment benefits are a joint federal and state program, and at the state level it's administered by their local claims. And in California, for instance, which is the second largest in the whole country, it's been a mess with all kinds of lags and fraud and inefficiencies. So it is an important indicator. It moves slowly. It can also be very noisy. So I tend to look at the average relative to the working population, because obviously as more people are working or looking for a job, the number of jobless claimers is going to go up. And when you measure it that way, it's about the same as it was before the pandemic, a little bit lower. And before the pandemic, the labor market was super tight.
So it's still super tight.
Yeah.
Yeah. So if we see what's your, and obviously it's not one number as you're saying, but if we saw 270 in the next couple of weeks, would that make you kind of raise your eyebrows or no?
Of course, but I would look at the average.
You want to see a couple, right?
And also there are other labor market indicators. So the NFP, obviously, but the JOLTS. I've criticized forever the openings data in the JOLTS, but there are actually a couple of series in there that I monitor very closely, and it's a quit rate and the layoff rates, and those are still stronger than before the pandemic. So with the labor market
slowly coming down, but still above pre-pandemic at a time that the Fed just raised rates by almost 500 basis points.
Exactly.
And if it's not, it should be much below as opposed to, but 100%. It is slowing. Yeah.
100%. And that was, by the way, one of the points made by Waller. We've raised the rate and not much has happened. So in terms of this week's data, we are lucky because there isn't too much going on. Mind you, each time I've said there is not much going on, that's when we had a blow up of one kind or another. But so we have a bit of data on the residential market, which is important because it's the most interest rate sensitive part of aggregate demand. And despite the 500 or so Fed funds hike, it's actually recovering. If you look at prices, they are stabilizing. So even if you look at indicators of investment, they are doing much better. I mean, we are talking about smaller contractions. So what we have this week are things like housing start, existing home sales, perhaps not as important as, say, construction spending or prices, but it's still going to give us an indication of whether the recovery is continuing. And by the way, I would say that, with the lower long-term yields, we're having lower mortgage rates, of course. which is a point made by Bullard, by the way, that any tightening of credit conditions would be offset by an easing of financial condition. And so far,
Right,
with
the issue that they raise rates and the long end starts saying, oh, now we're really worried about them. Something like, you know, the Wile E. Coyote, whatever, who, you know, was
yeah.
Summers comment.
Yeah.
So it's not actually pushing up long-term, I mean, a little bit, but not really pushing up long-term yields. So, and they I guess they can't accelerate QT. And
well,
whether that even does affect long-term yields, you know.
Well, yeah, and the problem with MBS is that no one is refinancing. So what they have on their balance sheet is super long duration, and it's rolling off very, very, very slowly because as those rates. And so, and if they sell, if instead of letting it roll off the balance sheet, they start selling, they will have to book huge capital losses. And as you know, the Fed is already making losses, which are bound to become quite political. In fact, Governor DeSantis, in his book tour, has criticized the Fed very heavily, not so much about the losses, but more about their overly loose policy. So their hands are tied. If they want to do faster QE, they have to take more hits to the balance sheet, and I don't think they want to do that.
Right.
So inflation, here we go. So, and then we get the surveys, we get manufacturing surveys. So we get the New York Fed, which is called the Empire. We will get the Philly Fed. We will get the S&P manufacturing and services survey. I mean, to be honest, this is data, of course, I'm commenting on, looking at, but surveys have become quite detached from hard data.
Yeah.
And then the manufacturing surveys, manufacturing is like 10% of the economy. And it used to be the case that manufacturing were leading services, but no more. What's leading services is codes, software, chat GPTs. These are the things that are leading growth, not the manufacturing of widgets in some place in the hinterland. So anyway, we'll have that. We'll have those surveys. I'll pay attention to the services PMI, where the consensus expects a small decline, but still services in expansionary territory. I mean, to be honest, the US economy is 70% consumption. So as long as you have a good handle on what is going on with the US consumer, you're probably more likely to understand what's going on with the broader economy than if you look at all of the details of those.
And you were not spooked by a slightly softer headline for retail sales?
No, because there is something very funny. I mean, it's not funny, but there is something strange going on there. So basically, people splurge on goods during the pandemic, and now they spend less, with some little twist to that story. Like, for instance, Americans are still buying a lot more food than before the pandemic. It's not growing, but if you look at the level in real terms, it's much higher than before the pandemic, which makes me think people are still afraid of lacking, of not being able to find food in the shop. But so that's flat. And in the past, it's been a source of growth in consumption. It's gone. And the other thing that's going on with cars, which is very interesting, the real value of individual car purchases is coming down, which means people were buying more expensive models, because during the pandemic, manufacturers sold only the top of the line expensive cars, which they could afford because there was so much excess demand. Right. And now that both supply and demand are normalizing, people are going back to buying the same mix of a cheap and expensive car that they were buying before the pandemic. And that's another reason why goods sales, so retail sales, are very dull, or perhaps even contracting But
Right.
if you look at the overall situation of the consumer in terms of wealth, the net worth is still higher than before the pandemic, despite everything in the real estate market, equity market, and so on and so forth. The leverage, the debt service ratio is about the same as it was before the pandemic. And more importantly, real household income, excluding government transfer, it's booming. So you have a little bit of a normalization of household savings, but very gradual. And you know what? This normalization basically reflects that people had a larger and larger number of people have spent all of the government stimulus. But you know what is the consequence? They are going back to work. And that's why labor participation is going up. And that's one of the things that is fueling income growth.
Right.
So, you know, the US consumer, it's a little bit like the Energizer bunny. It never stops. I'm joking, but I think they are in okay shape.
Yeah.
And I would put this poor retail sales number in context.
In context. And clearly the market agreed. I think, you know, initially maybe there's some weakness, and then also people looked through the numbers. They also said some of it was because lower gas prices, I think at the time, there were some other things that people had issues. So, okay, awesome. Thank you. So I'll just give a quick recap of some of the stuff that we put out for our pro users. I mean, an absolute thing to check out every week is our model portfolio, which must say has continued to, which is obviously quite supportive of risk. It has continued to perform very well. We have a Sharpe ratio of over 2 since inception, which is really amazing. So I recommend people to go through that, see all the trades we have, and actually engage in any questions of why we have these trades. We're going to be looking to add probably a few more trades this coming week as well. I mentioned briefly Bilal's macroscope this week, 3 puzzles to solve in the markets. All amazing questions. Certainly why equities have hung in there, certainly during the recession 4.0 scare. Is inflation falling, and if so, why not? So kind of going through the details, and then what are small businesses telling us, and especially outside the consumer, also probably less and less, as your friend Matt Stoller likes to say, but small businesses are still a very crucial part of the U.S. economy. Oil Weekly, which you touched on from Varesh, where the EIA, the U.S. and international oil associations predicting that there will be a supply deficit later in the year, and I think it goes against what some people were thinking, and maybe is then fits into a bit of a surprise for the recent cuts in OPEC, but longer conversation about that. And also, as Varesh had touched on, I think last week, that supply is kind of topping out or basically stabilizing. It's not continuing in the US, which is also another obviously very key part of the oil supply picture globally. Mustafa, a great piece on Global Rates Weekly and why it's not just the Fed that's actually really driving interest rates. Super interesting piece for our prime users, and certainly for ultra high net worth, kind of to any kind of casual investor, to students, highly recommend it. We've made some incredible improvements over the last 6 months, so amazing job to the team. And so the crypto index tracker, why that Delvia breaks down why Ethereum continues to outperform, which has been a great piece. Richard Jones goes through the G10 FX weeklies, had a great call on the kind of bearish dollar, kind of bullish euro for several weeks, and certainly when a lot of people were very bullish on the dollar. And I would just, we do this trade ideas weekly, and with a highlight specifically this week, but often on FX and crypto, and that gives a real good breakdown, and I guess put together by Ben, which I highly recommend for our Prime users, our free light users to check out. If you don't have access, please check it out. And yeah, and that's it from our side. A lot of interesting stuff that we put out this week. I don't know, any parting words?
As always, please send feedback, and critical feedback, actually extremely helpful. And other than that, good luck, everybody, and see you in the markets.
Awesome. Thank you so much. Thanks, Dominique. Good luck, everyone.
Bye, Andrew.